the most important aspects when we're going through financial planning with clients is really understanding your tolerance to investment risk, because this is going to have a critical impact on the types of investments that we may recommend for you. So we will go through that in a few different ways, and I really want to get you to understand what is it that we're talking about when we say what is your appetite to risk in investments. So what is risk profiling? So risk profiling is basically a really important part of it. It's to be able to advise you on the investments that we need to understand what is your appetite, in a sense, or tolerance to risk. So it's a process of calculating your attitude to risk with the aim of not only determining the financial risk you have the capacity to take, but also the level of risk you are willing to take. So it's kind of a three-step process when we go through this. We'll get you to complete a risk profile questionnaire. Now, a lot of advisors stop at that point. Now, what I do as part of our practice is we then obviously get to know you going through this process, but I will go through that risk questionnaire and I'll really try and link that with your personal and financial goals, go through some of the responses and really see if your responses actually reflect some of our discussion. If they don't, we'll kind of go through in a bit more detail on that. We'll then agree on a risk profile and then match you with investments that kind of agree to that risk profile, and keep a track of that. So now, what are some of the questions that are included in the risk questionnaire? So that questionnaire, that is a standard questionnaire that comes through from our licensee, our financial planning licensee, and this is probably pretty much standard across the board. The types of questions that you're going to get asked are going to have themes such as the following. Now, if they won't ask these particular questions, they're going to ask you various different questions in lots of different angles, and they'll ask the same question twice in a different way, just to kind of test where you come out with on that. So, what stage of of life are you at? How much do you know about investing and investment matters? How long before you would you need to access the money? What are your investment goals? How would you respond to a specific investment scenario, such as a COVID-19 and everything collapses? How much potential loss are you prepared to accept in return for potential gain? Now, some of the personal factors that I will then go through with you, I'll get that risk profile and I'll really try and have a look at it and go, okay, well, what's your current financial situation? What are your debts? What are your other ongoing expenses? How much income do you earn? And how much money do you have to invest, and what risk are you able to take? I'll look at some of your investment goals. So what are you hoping to achieve with your investments? Are you saving towards a particular goal, for example, funding your retirement, or simply aiming to build some wealth? I'll look at your time frame, your investment time frame. Now, look, if you're 2 years off retirement, my recommendation is going to be very different from if you're in your mid-30s and you've got time on your side from that perspective. So that's going to play a big part. Do you need to maximize your returns in a short period of time? Are you happy to play a longer game? What risk is required for you to reach that goal in that desired time frame? And then I'll look at your general attitude to risk. Are you someone who kind of, wants to put the money under the mattress? Are you happy to, give something a shot that's, potentially really risky, but could actually end up with a big return? So it's those types of dialogues that I like to have so that we really can come up and basically agree with what is the most appropriate risk profile. Ultimately, the risk profile that we come up with and we start investing your money in should be reflective of how you. Now, I often say I want you to still be able to sleep at night. So if you're someone who's quite a low risk investor, such as a conservative, you're not going to be wanting to invest in all of these high growth stocks that maybe you lose your money tomorrow. So my whole goal is, from a risk profile perspective, is making sure that we're investing where you're comfortable and you can still sleep at night. So generally speaking, the greater the risk of an investment, the greater the potential returns. However, opting for a riskier investments means you've got to be willing to accept that you may potentially lose that money. And how comfortable are you with that? Now, there are certain names to risk profiles. Some of them vary in different whoever you're speaking to, but generally speaking, they tend to fall in one of the following categories. So we have conservative, you want stable, reliable growth and high level of income, and you're only willing to accept minimal losses and may have a short-term investment time frame. That's often, that might be someone, and look, that can be someone at any age. We tend to see that the closer you get to retirement, the more you start to get a bit more conservative with where you're investing your money. You're really looking at income return more than growth return. Moderately conservative. Then we have balanced. Now, you're looking for a diversified portfolio that contains a balance of security and potential for growth. You're willing to accept a certain level of volatility, but you're typically prepared to, because you're prepared to invest for about 5 years or longer. Then we have the growth and high growth. You want to invest in a broad range of asset classes with greater focus on growth rather than income. Now, if you were actually about to retire in a year, that may be an issue, because when we're looking at retirement, we want funds from an investment and from an income perspective to be able to pay you a pension. So often with growth, we're looking at investing of up to 10 years. And then we have high growth. So we might have long-term capital growth as your main focus. You probably have time well and truly on your side. So at least 10 years, and and you'll invest in that side. What's interesting, actually, I'll just go back to growth and high growth. If I speak to the average Australian, no one tends to realise that property in the financial world, property such as residential property, commercial property, is actually considered an investment that would be characteristic of someone who's in a growth, high growth. Now, in the past, a lot of people in Australia tend to think that, I invest in property, does it double in 10 years, or, what's some of that? But actually, it is considered to be a growth or high growth type asset. And that's something to be considered at when we're going through this type of scenario. When I look at those different, I've just pulled out two common risk profiles that I tend to see, and just to explain those a bit more. So when I look at a growth risk profile, that's a bit like your property that I was talking about, where you're investing in an asset that's a high growth or a growth asset, that a minimum investment term is more on 8 years. And the income side of it, we're looking at, it's basically you're investing 80-20. Now, if I go back to my property analogy, let's face it, a lot of the rental returns that people are getting now, 2% yield, very minimal returns, but they're really investing for the growth in the property. Now, if you look at that minimum investment term, 8 years, net return objective is CPI plus 3%. Now, on a growth asset, maybe it's a property, it can be other stocks. That's potentially the outcome that you would get over an 8+ year investment. Now, if I look at a balanced risk profile, minimum investment term tends to be about 6 years. And the goal is kind of around, the objective is CPI plus 2.5%. So what we're looking at with a risk profile of a balanced is having your portfolio invested in 70% growth type assets and 30% income producing type assets. So hopefully that gives you a bit of a background as to what we mean now when we start talking to you about your risk profile, and how also then your risk profile will actually influence how we will make our recommendations from an investment perspective. Please don't hesitate to contact us if you have any further questions. Thank you.